battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show, the last episode of 2024. I don't know if you can believe it. I certainly can't. 2024 flew by. Episode 171. Happy New Year to you and your family from the Stenger Family Office. I hope you had a very merry, wonderful Christmas. Hope you enjoyed the time with friends and family. But, oh man, it is time to think about 2025. We did our market outlook show not too long ago. We told you what we thought the S&P would do, and we'll see what happens. I will say we'll pull out the crystal ball for the last episode of the year. Oh man, this thing is heavy, very heavy, a little cloudy. Can't always tell you what we think is going to happen next week or the month after or even 6 months from now. But if you do the math, the data, the statistics, like the hat behind you here on the bookshelf, behind me here on the bookshelf, we do love the math. We love the data. And if you look at the math of the market, I think markets are set to go higher from here. So stay on your plan, stay bullish, stay optimistic, and don't panic. Some of you are saying, Nick, you said the market was going to go up, and now it's down 2.8%. What in the heck is wrong with you? How could you get it so wrong? And let me just tell you, I never promised when I said the market was going to go up. I never said it was going to go up in a week or a month or 2 months or anything like that. But I told you directionally, I think the market's going to go higher from here. So don't panic. We're in a 2.8% correction. Don't let now your heart be troubled. Don't jump off the ledge here, and just stay on your plan. Don't look at your statement. If you even know that we're in a 2.8% correction and you're not me or somebody else in the finance industry, you're looking at your statement too much. You're looking at your accounts way too much. And by the way, I know if you're doing it, our technology is good enough now where I get a report of who logs in the most to their account. So I can see that you are having a mini panic attack. The market's down 0.5%. You're freaking out. Don't freak out. Don't even look at it. And go for a walk. Enjoy the time. You're probably not walking in Illinois here. A little bit cold, although a little bit warmer here for the winter months so far. But get out of the house a little bit. Find a different hobby. Don't just sit there and look at your statement or your Schwab app. There's so many more things to do with your life other than panicking every time the market goes up or down. So stay on your plan. That's my message to you. And aren't you glad you stayed on your plan in 2024? Certainly been a phenomenal year. And you are thinking, but Nick, we're in a 2.8% correction. And isn't that bad? Well, no, the market's still up 25, 26% for the year. How is that a bad year? Let's not forget where we were at the beginning of 2024 and the end of 2023 when all the doom and gloom pundits on Wall Street, remember, they said market was going to go down 8 to 10, maybe even 12%. In the most bearish cases, we were trading 47.50 on the S&P, and they said 42.50 in some cases. And you're thinking, how do these people still have jobs? How could they be so wrong and still stay employed? Great question. Beats me. Not really sure. Don't have an answer for you on that one. They probably couldn't even get hired at Fuddruckers, but somehow they're still advising on billions and trillions of dollars at Wall Street. And it just baffles me that these people still go on CNBC. They manage $0. They have zero responsibility to produce a track record. And yet the media parades them out like they're heroes. So just be careful who you listen to. And I keep telling you that. Watch out, because you know the doom and gloom is coming. You know that the narrative is going to change. And right now it's a pretty decent narrative. People are still pretty optimistic, still bullish on stocks. That will shift at some point in the new year. So just be ready for it. We're not going to be surprised by it. And by the way, how do we do financial planning? How do we do investment management for you? Well, we don't do it on a risk-based program, because if all we do is sit down and I put you through a risk tolerance questionnaire and I say, hey, how do you feel about risk? Are you worried about the market? If we go down this much, how much of that can you accept? How much risk tolerance do you have? And when the market's at all-time highs at 6,100 on the S&P, you're feeling pretty good. You're like, Nick, please put me in Bitcoin, put me in meme stock, put me in pot stocks, put me in whatever we can get that's high-octane growth. And that's not necessarily the right thing. I will tell you, don't do that. That's a bad idea. We might miss some of the upside, but eventually when that bubble pops, we will avoid the downside. So that's not the right approach. But on on the other side, when things are bad, and I ask you when the S&P goes down and it's at 5,000 or in a correction at 5,500, which is very possible, that can happen very easily in a 10% correction. If I go back and I ask you, how do you feel about risk now? You're going, Nick, I hate risk. I hate stocks. Please give me cash. Give me gold. Give me guns, butter. Build me a bunker in my backyard. Fill it with canned food and water filters. And please never, ever put me back in the stock market. And right when you're feeling that way, the market is at the best possible buying opportunity. So you cannot have a risk-based plan. You've got to have a goals-based plan, which looks out for a few years at a time, maybe even many years at a time, and says, well, what are we trying to accomplish? And number one, if you're approaching retirement, you got to have a couple years of savings for a rainy day. We call it just treasuries or something that would be a little bit safer, maybe even some money markets, some cash in the bank. And if you got 3 to 5 years of that set aside, that's risk-free, that's not tied to long-term bonds, that's not tied to interest rate fluctuations, which, by the way, we'll talk about in a second, long-term bonds and what to do with the bond market right now, in my opinion. We'll get to that in a second. You would say, all right, I got maybe 20% of my portfolio pre-retiree in high-quality, short-duration U.S. Treasuries that used to pay me 5%, now are paying me 4.25%. Okay, no big deal. I don't really care about the interest rate. Why? Because those treasuries are providing me with a buffer when times get tough. And you know they're going to get tough at some point. That's just the reality of economic cycles. So when things do get bad, not if we have a correction, but when we have a correction, you're not having to panic and sell your stocks when they're down. You have your treasuries to draw from. Every other dollar in the portfolio goes where? It goes to U.S. high-quality equities, where you're going to grow and beat inflation for the long term, some of which are dividend payers, some of which are more growth oriented and are going to give you a nice growth to value mix during an inflationary environment or a deflationary environment. And so I think that's the right way to be thinking about it. You've got to have a goals-based plan. If you're starting from a risk-based plan, what's going to happen is you are going to check your app every 5 seconds. You're going to check your statement. You're going to go on Schwab every 2 minutes, and the market's going to go down 2.8%, and you will have a panic attack because you're not properly prepared for the future. Instead, what we want to do is have that goals-based plan that already looks into the future. We know if we have that goals-based plan, and the goals-based plan has what we would call a high probability of success, your future is secure. So don't panic. Do not be alarmed. Let not your heart be troubled if you're on a goals-based plan. If you're not on a goals-based plan, if you are just winging it, if you are just buying the cool new thing, if you are chasing the highs and selling at the lows, which is, by the way, the opposite of what you're supposed to do. You're supposed to buy low, sell high. Easier said than done. Most people do the opposite. They buy high and then they sell low. Not such a good investment strategy. You should be worried. You should have your portfolio looked at. You should get with a fiduciary financial advisor who's going to say, hey, stop this nonsense. Let's get you on a plan. And that's what we want to do at Stenger Family Office. So stay on your plan in the new year. Do not panic. Just a little recap here. S&P 500, I mentioned, is up 26% for 2024. We had an unbelievable year this year, had an unbelievable year last year in 2023, 2 back-to-back years. But remember, we were coming off of some doom and gloom and some pretty low numbers as far as valuations were concerned. And if you took the S&P, by the way, when we produced Bye Bye Baby, that episode where we said, hey, buy like it's going out of style, buy like there's no tomorrow, you were essentially buying the S&P on a 15 forward price earnings basis. That thing was so cheap and you couldn't ignore it. And so we told you that. We said, buy stocks. By the way, I promised I would tell you when I thought stocks would get expensive. I don't think we're there yet. I think we're fairly valued. I don't think we're undervalued. I don't think we're significantly undervalued. Certainly not like we were a few years ago. But I don't think we're radically overvalued. If you go off of what we think expectations are going to be in 2026 now, remember that's where we're starting to trade the market. You go off of today's S&P right around 5,900 points. You use $320 in estimates for the S&P for 2026. You were buying the S&P today at 18 and a half times earnings. That's not radically overpriced. It's a little pricier than historical, but it's not radically overpriced. And again, if you're on a goals-based plan, who cares about 1 year return? Who cares about 2 year return? It matters in some respect, but what really matters way more is what's the S&P's return going to be 5 years from now or 10 years from now when you're looking back? Most of our clients, let's say you're in your 80s, let's say you're in your 70s, let's say 60s, 50s, 40s. I would say even if you're in your 80s, if you plan on being around for another 5 years, why can't you be on a 70-30, 70% equity, 30% plan? If you're in your 70s, why shouldn't you be on an 80-20 plan? And I would submit to you today that if you're not on a 70-30 or 80-20 plan at those ages, your big risk inflation will catch up with you. And so this gets into what I wanted to comment on with the bond market. I've been pounding the table on this all year, saying watch out for bonds, especially watch out for long-term bonds. I do not think we are out of the woods when it comes to inflation. The Fed is, my opinion, prematurely cutting interest rates and probably should stay higher for longer. They waited way too long, and we'll see what happens. But what the long end of the yield curve is telling you now, we're starting to uninvert. So short-term yields are starting to pay a little bit less. Long-term yields are going up. The Fed cut 100 basis points, and you'd think, hey, rates are going to go down, right? We were going to see mortgages finally come down a little bit of relief on used car loans. Not the case. Why? Because the bond market is leading the Fed, not the other way around. What's the bond market telling us today? My opinion, could be wrong, but I think we're going to avoid recession, at least for now. We may have one eventually, have one in the next 2 years or something like that. We'll see what happens, but I think we're going to avoid recession. That's what the bond market's saying. If the bond market thought we were going into recession, that 10-year yield should be in the 3.5%. It's not. It's like 4.4, 4.5%. And by the way, if you do a lot of the stuff that the new administration is talking about, which I think a lot of is positive, again, I know some of you hate the big orange man, okay? So I'm not endorsing anybody politically. Please put your political differences on the side for a second. All I'm going to tell you is that I think some of the policies are very favorable, but some of the policies are also inflationary. If we start doing reshoring and manufacturing, if we start growing again towards that 3% GDP target, if we start having some good things in the economy, we avoid recession, but what also happens is inflation goes up, and the Fed's going to be forced to keep rates a little bit higher for longer, not in the 6, 7, 10, 20% range like we had in the 80s under Paul Volcker, but certainly a little bit higher than we've had the past 10 years. So don't panic over any of this. Don't worry that the world is coming to an end because the 10 years at 4.5 or could go to 5 or 5.5. That's actually a pretty normalized yield curve. In fact, that would be a lot healthier for the economy if we're at a 4.5 or 5% 10-year Treasury. And so what you're starting to see now, and this is where I think the large caps continue to outperform. That's why I've been telling you, stay in high quality blue chip companies, especially the top 50 of the S&P 500. Why? Simply because a lot of these companies now, for the first time in history, think companies like Microsoft, think companies like Berkshire or Apple or Amazon are sitting on stockpiles of cash, okay? And by the way, if you look at their income statements, they are making more money in interest, first time ever, than they are paying out in interest expense. They are the new banks. Not really, but that's kind of the conceptual idea of it, is that large cap companies are so fortified, such strong balance sheets, that they literally are operating like banks. They're making more money in interest revenue than they're paying out in interest expense. So that's the thing that a lot of people missed. And this is why the bears, yes, they were right in 2022 when the market went down. But what they didn't understand, the reason they missed the recovery in 23 and 24, remember Michael Burry, the famous hedge fund guy, smart guy, not talking badly about him as a person, but this is why when he tweeted out January of 2023, sell, you're like, hey, good thing I didn't listen to him because the market went up over 20% in 2023, 20% 2024, and I think we got a good 2025 ahead. Here's why they missed it. Because they forgot that large caps had such strong balance sheets. So when you're in the stock market, don't forget it's not Fugazi, Woozy Wazi. It's not just S&P 5,900 points, up 1%, down 1%. When you're in the stock market, you literally own a piece of 500 different operating companies, the S&P 500. Stocks, like Dr. Jeremy Siegel has pointed out a million times, are a claim on real assets. And so when you own Apple stock, what do you own? You own a piece of their goodwill, their intellectual property, their plant, their property, their balance sheet, all the cash that they have, you have a piece of ownership in that company. So don't forget that stocks are real. Stocks aren't just fake. They're not just made up. And so when the stock market rises or a stock goes up over time, it doesn't just go up on a fantasy, at least not in the long term, not on a fugazi. It goes up because it's more valuable, because its profits are going up. And the opposite is true. So if a stock goes down, you better be careful just buying a stock because it's down, like a company like Walgreens, for example, or some of these other names we've mentioned. Why? Because there may be some trouble that you're not seeing unless you go look at their balance sheet, their income statement, their cash flow statement. And so that's what we want to try and do, is keep our clients in the highest quality names. And that's where I think you're not going to be completely insulated. There's no protection in stocks. Stocks are not safe. Just remember, stocks will go down when the market goes down. But I do think over an entire cycle, large caps are better prepared to handle downside. And so all of you in your target date funds, or you're letting, I'm not going to name any names, but you're letting one of these big corporate places manage your 401k for you, you should really ask the question, what do I own? We have a lot of clients who are engineers, and so you love numbers, you love math, you love data. Well, peel back the layer of your portfolio. Look at what you got. You may be very surprised to learn that you have a low quality portfolio and not prepared for a rainy day, which you know is coming. So human nature does two things. Human nature says at all-time highs, when things are great, when nothing can go wrong, you think to yourself, everything's going to be great forever. That's not true. Times will get bad again. But then at the bottom, when things are not going well, when we're in times like 08 and 09, we also tend to think things are never going to get better again. That's not true either. It's somewhere in the middle. So am I optimistic on every single piece of the market right now? No. And I've been very clear on that. I've told you I do not think every piece of the market is undervalued. In fact, I will tell you, okay, and I run screens every day. We have a process with our portfolio management, our internal investment committee here at Stenger Family Office. We look at this literally every single day of the week. I look at companies, I could probably tell you 20, 30 names that are just overvalued. There's no other way of looking at it. Their revenues are only up maybe 4 or 5% a year, and the stock trades for 150, 160, 200 times earnings. That is not sustainable. And if you pay 200 times earnings for a company, you can eventually pay the ultimate price for it, which is just not a lot of return for years. Look at the Cisco investors in the 90s, still have not recovered their losses 25 years later. And the same is true, I believe, for some companies today. I'm not going to name names, but I think there's a lot of companies that are overvalued. And then I think there's a lot of companies that are undervalued. And so that's what we're trying to do in the portfolio. We did our big rebalance in November last month. We're doing some little tweaks here and there as companies get cheap. We have a watch list of names that we really like, and we're just seeing if they get a little bit cheaper. We did a trade yesterday for you if you're in the portfolio. So we're looking out into the future and saying, what do we think is undervalued? What do we think through our Stenger process is going to be a good long-term hold? And that's what we're really trying to do for you, is we're trying to say, what's the next 3 to 5 years? What's cheap? What's expensive? And let's keep you somewhere in the middle, because the big risk to investors is you pay the wrong price for a great company. So that is one of the major things we're looking at. We are going to wrap up just a touch early today, but I want to leave you with this. This is from Dan Sullivan, strategic coach. He coaches CEOs and entrepreneurs and business owners all over the country, been around for 40 plus years. And he has this saying that's just phenomenal. I'd like to share this with you. And he says the secret to success, or the secret to having an abundance-based mindset, is to always keep your future bigger than your past. And so that's, to me, what New Year's is about. And so as you celebrate with your family and friends, as you think about your New Year resolutions and what you'd like to do in the future and what you'd like to accomplish, that's how you really keep the future optimistic, is you have to keep the future bigger than your past. And by the way, isn't that the story of the U.S. economy? Isn't that the story of entrepreneurship? Isn't that the story of innovators and people like Elon Musk? You may love him or or hate him, whatever. Put that on the side for a second. Just look at the raw innovative value. Look at what these people have done for our economy. People like Jeff Bezos at Amazon and all these great entrepreneurs. I think another reason, by the way, Shark Tank is so popular, many of us like to watch Shark Tank, is because we like to see the American dream come alive and see that anybody, if they have an idea, they work hard, they put a business together, can be successful. I mean, there's people on Shark Tank who mostly come from nothing, who have no entrepreneurial background in some cases, who just worked hard and innovated. That's the story of America. That's the story of our entrepreneurs. That's why our stock market is beating everybody else. And that's why China, without this most recent stimulus package, would have been only up 3% for the year. Japan's up like 3 or 4% for the year. Europe is down for the year, and it's why the S&P, our U.S. stock market, is up so much. All of the innovators, all the entrepreneurs, all the forward thinkers from all over the world have gathered on our soil. And so I would just stay optimistic for 2025. I think we've got good things coming. We're going to have a correction. We're going to have some downside. We're going to have some doom and gloom stories that none of us see coming. So brace yourself for that. But as long as you keep your future bigger than your past, I think we're going to have some exciting times ahead. Thank you so much for being with us, coming back to the show every week. Thanks for watching Bullish this year. Thank you for coming to our events. We've got some exciting ones coming next year. Thank you for being with us. If you're a client of Stenger Family Office, thank you so much for your support. Thank you for the trust you've placed in our team, and we just can't wait to see you in 2025. Take care. We'll see you next time.